so now we're going to look into what would happen if I were going to transfer an asset to a corporation. Okay, so here, this is me. I have a sole proprietorship, okay, and I've got like this business going on, and I'm like, yo, I want to incorporate. I want to basically, instead of doing my business as a sole proprietorship, I want to do it as a corporation. I'm going to call it Barley Limited. And there are a couple of reasons I would want to do this, like the whole which is like the whole stuff about, the benefits of incorporating, like the thing that you have limited liability and stuff like that, or unlimited liability. No, it's limited liability and just stuff like that. So there are a lot of benefits for me to incorporate. And so the question then becomes, when I move, let's say I am moving my things, so I'm moving my machine, my furniture, all my assets and everything, all my cash, everything to this corporation, what happens to them, right? Like, can I just like move it to them and it's like, oh, it's no big deal, whatever? Or is there more stuff? So the first thing you have to look at is that is it like a sale? Because it kind of is. Like at first it belonged to me, but now it belongs to this corporation. So if it's a sale, we'd have to recognize some capital gains. Like for example, if the machine value increased, like the fair market value was bigger than the cost, then we would get some capital gains. Also, so this is if it's like a machine, we would get like capital gains. If the thing is like inventory and the inventory's market value increased, then that would be considered business income. I think it's like I think we consider like a sale of inventory, I guess, which is like just sort of like a normal sale, like normal revenue. So this would be considered business income. Then we also have, if this was depreciable property, like for example, an equipment, we'd also have to worry about recapture. So if the UCC would, so if the UCC, so remember recapture is basically UCC less the minimum of, and I don't like this pen thing here, cost and the fair market value. So basically, if this number was, let's say like this is like 10, this is 15, and this is 10. Let's say, wait, never mind. Let's make this 20. This is a bit dumb. Okay, let's say this is our val. Wait, this is kind of dumb. What am I doing here? UCC minus thing, how to be bigger than 0. Am I done? Okay, whatever, hold on. The UCC minus the minimum of the cost and fair market value is less than 0. So if this gives us a negative number, so for example, if this thing was 10 and this thing was 5, then 10 minus 5, never mind, okay, has to be the other way around then. If this was like 20 and this was 25, then using these two numbers, it would be 10 minus 20, which gives us a negative number. And so if we have that condition, then we would have recapture. And by the same sort of like thought process, I guess, if the UCC minus the minimum blah, blah, blah is bigger than the 0, then we would have a terminal loss. So it's just like there's like a whole bunch of like losses, gains, income, blah, blah, blah. But I'm like, yo, like it's just myself. It's just me moving it to my own company. Like, why is it considered a sale? And that's why, right? Like, look at this guy. We're just moving my assets. So like, why would it be considered a sale? And like, why would I have to recognize all this income? So which is why the Section 85 rollover comes into play. So for Section 85 rollover, the basic gist is that the assets, for tax purposes only, remember, for tax purposes only, because in terms of accounting, legal stuff, in terms of like the thing that shows up on their balance sheet and all that stuff, it's still like the normal way. But this is only for tax purposes. The assets can be transferred at their tax cost. So their tax cost is either their cost or the UCC. If it's a depreciable thing, then it's either UCC. If it's a non-depreciable, then it's their cost. So blah, blah, blah. So what happens is that right now, I as a person have no gain, but in the future, if the corporation sells those assets, then they would pay all the tax. So it's not like getting rid of all the tax, it just defers the tax, okay? So the thing about transferring stuff at their tax cost is basically basically saying that the proceeds would be this tax cost. So let's say this is like land. Proceeds would be cost, and then you're selling it of cost of cost. So basically your gain is 0. Whereas before this proceed would have been fair market value, And if the thing had like increased in value, then it would have been like fair market value minus cost, and that would have given you some like, I don't know, gain. So right now we're just sort of getting rid of the gain by basically equating the proceed and the ACV kind of thing. So that's the gist of it. So it's not like I'm getting rid of all the tax forever, it's just deferring the tax to when the corporation deals with it. Okay. There are some conditions for the Section 85 tax thing. For one, when I sell my machine to the corporation, like when I give the machine to the corporation, I have to get some type of shares. I think it's usually preferred shares. I'm not really sure if common shares would consider, but I don't think it's like that big of a deal. So we're just gonna stick with the preferred shares for now. But anyway, I have to get at least some shares from this corporation. I don't know why. Maybe it's to like to show that I'm like getting some type of ownership in the corporation, I guess. Which kind of makes sense a little bit because they want, I guess, kind of proof that I'm selling to this, I'm giving the assets to a company that is related to me. Like it's just me transferring over to my own corporation. So I guess they sort of want us to have a bit of shares to sort of show that, you know, we own the company, blah, blah, we have a bit of equity in it, etc. Stuff like that. But yeah, that's like one rule. And blah, blah, blah. And also another thing is, so basically the money, the stuff that I get back from this corporation, God, I don't like this marker. So the stuff that I get back from this corporation is going to be a mixture of shares and some non-share stuff. So this non-share stuff could be cash, accounts receivable, other equipment. I'm not really sure what equipment, but just like other stuff. And one thing is that we're going to assume for now that it's just cash, like the other non-share stuff would be cash. And the thing is, if you're given the choice between getting shares and getting cash, you would say cash because cash is like tangible, it's like an actual thing. So we would want to maximize this always. We want to maximize this thing because we want cash over shares. So like if you could, I would get like one share and like $20,000 of cash or $20,000. 20,000 cash, $20,000. Like that. So like if I could. Also another condition, I guess, is that it has to be eligible property. So it can be either capital property, which is non-depreciable or depreciable, or it could be inventory. There are a couple of other like rules, I think, like for real estate, stuff like that. But it's not that big of a deal for now. Yeah, like as in like only these type of things can be used for the Section 85 rollover. Cool, cool, cool. Okay. So Section 85 has this thing called a transfer price. So this is the elected amount. So this is that amount where at the beginning I was like, we would set the proceeds to, you know, like, I don't know, like the same thing as the tax value. Proceeds? What's it called? Tax value. Like basically this amount over here is the elected amount. And this is basically, this is like a fake amount that basically we're saying the proceeds are. Okay, so I say that this machine is valued at $85,000. And so that $85,000 is the proceeds that we're going to be using. So we're basically just making up an entire number for this value. This is all like very fake, okay? So in this case, let's say that the fair market value of this machine is $100,000 and that I bought it originally for $90K. So it's like if I were to, you know, normally, wait, I'm pretty sure I did this somewhere. I didn't? Could have sworn. Like, I guess not. Okay. So normally if I had to like I don't know, if it was like a normal sale or if I didn't use a Section 85 rollover, I would have recorded a gain of the fair market value of 100K minus the cost of 90K. So that's a 10K gain and half of that is taxable. So it's a 5K taxable gain. And that's what I'd have to report. But now I'm going to be making up a value. I'm going to make up a number for the value. And my number I'm going to use is $85,000. So it's as if I sold this machine for $85,000. And this $85,000 is now three things. This number is three things. First of all, so this $85,000 is the elected amount. This is the number that we make up. Okay, it's like the made up number, the fake number. So this number becomes three things. First is the sale proceeds for the seller. Okay, so it's as if I sold this machine for $85,000. So if I were to record a capital gain, My proceeds is $85,000. My cost is whatever, and my capital gain is this. This minus this. Okay? 2, for the corporation, it becomes their cost of asset. So originally, so when a corporation buys the asset, if this was like a normal sale, I would have sold it at fair market value, right? So on their balance sheet, this thing, on the balance sheet, their amount would be 100K. It would, because they bought it at 100K. So at fair market value is 100K. And that's what's listed over here. On the balance sheet, the machine value is 100K for the machine. I mean for the corporation. But it's just that even though like their accounting, their legal cost and everything is 100K, like the amount sort of that they paid, I guess. Hold on. Okay. I think this might make sense a bit more later. Okay, so on the official balance sheet, this official balance sheet, I'm going to go over here. So the balance sheet shows the fair value because that's the actual thing. Because that's like the accounting and legal purposes. Only for tax purposes do all these rules apply. Like the whole, the cost of asset is EA. So the only place where this would ever come into place, where the fact that the EA is the cost of asset, is if this corporation was going to sell this thing. In that case, their capital gain would be whatever amount they'd sell it at. Let's say like, what? Okay, I'm not really sure what I wrote over here. Accounting gain, blah, 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 capital gain, blah, blah, blah. Okay, so let's say that the corporation sells this machine in the future. The capital gain that they would record, let's say that they sold it for 100K. I know it's getting kind of messed up because 100K is also the fair market value. But let's just say that they sold it for 100K to like some random third-party guy. The gain that they would recognize is that proceeds minus the EA. So remember, the EA becomes the cost of the asset for the corporation. And so in terms of tax stuff, in terms of their capital gain for tax purposes, this is the number that we use as the cost. Whereas in terms of accounting and like the legal stuff, the number that we use is actually the original, like the fair market value. Like this, whatever. It makes sense. Okay. One thing to note is that if the EA is less than the cost, this is sort of like a rule. Like forget about this accounting gain stuff. Only look at the capital gain stuff. If the EA is less than the cost, like over here I chose an EA of 85K, whereas the cost is 90K. In that case, this cost over here would become their corporation's capital cost. So basically what it means is that if they were to sell the thing in the future, their capital gain equals 100, their proceeds minus 90K. So it's this thing minus 90K. If sometimes the EA might be like bigger than the cost or it might be equal to the cost, in that case, don't really worry. But if the EA is less than the cost, then the cost would be their capital cost. Not really sure why. I think it is this is for non-depreciable property by that, I think, right? This is for, yes, I mean, no, this is for non-depreciables, not, wait, no, I keep thinking, this is for depreciable stuff, so things like machines, stuff like that. Wait, why? Note that if EA is less than the cost becomes the corporation's capital cost, and the UCC remains at the EA. If this is a depreciable thing, okay. If this is I cannot think that fast in my head. Okay, I will come back to this. Actually, no, I'll do it right now because we have the time. This video is gonna be long anyway. Okay, let's say we've got a machine. The fair market value equals 100K. The cost equals 90K. The UCC equals 85K. Let's say that I set an EA of 95K. I don't really know why I would do this because usually we would set the EA at the UCC. but for some reason, we're doing this, okay? So we'll leave it at this. So the rule, I remember the EA is like basically the fake number that I came up with. So the rule says that if the EA is less than the cost, oh, my bad, the EA has to be less than the cost. That's beautiful. EA of, let's say I choose an EA of 85, which is a UCC, right? So if I choose this EA, what this means and what this rule is telling us is that the cost becomes a corporation capital cost. So for corporation, cost equals 90K for tax purposes, by the way. And their their UCC equals 85K. Okay? So what does this do in the future when they're selling this stuff? Let's say that they're selling this item at like, I don't know, 120K. Their capital gain equals 120 minus this $90,000 here, 90K. So that is 30K divided by 2 equals 15. And their UCC stuff, like the whole recapture stuff, would be UCC of 85. We're going to assume that this guy does not like, reduce UCC, whatever, less the cost. And I guess in this case, the cost is this thing over here, 90? Ah, why is it so cold? Proceeds is, so this guy's selling it at 120K, but the cost is going to be lower. Which is a cost? Is it this one? I think so. Wouldn't be this. This is all tax stuff, tax purposes, so it would be the 90K. Okay, 90K. So it'd be this one over here. So this gives us a value of -5. So basically $5 of recapture. Cool, cool, cool. Funsies. So this is what the rule tells us. We would record this much of capital gain and we would record this much of recapture. So let's say that let's say we sort of ignored the rule. Like we decided to leave the corporation's cost at 85 and the UCC at 85. Is that what they're saying? Costs are probably received. Wait, what happens to the UCC? Okay, we'll leave that alone. This one is following rules. Following rules. This is not following. So for tax purposes, oh my god, the room is so cold. The corporation's cost is now the EA, so it's 85K. The UCC just stays the same. That thing doesn't change. That's still at 85K. So if I future sell at 120, same thing as this. My capital gain is 120 minus 85. That's a bit higher, I guess. 35 divided by 2, which is 17.5. Whatever. UCC is 85 less cost of 85. Proceeds of 120. So over here, we choose this, 0 recapture. So in this case, divided by 2 equals 17.5. So in this case, with the rule, the guy is actually paying more because he's paying $15 of capital gain plus his $5 of recapture. And the funny thing is, since recapture doesn't go under the whole divided by 2 to, like, if for recapture it was like divided by 2 to get like the taxable amount, it would have been 2.5, and 2.5 plus 15 would have been 17.5, which is beautiful because it's like the same thing as this. But this cool rule that they're setting in place actually makes it so that you're paying more. You're paying 15 plus 5 equals 20, and that one you're paying 17.5, like if we sort of ignored the rule. So the rule is actually making us pay more, which is pretty cool. I'm not like cool, but obviously the government wants more money, so I guess that's why they're doing it. But like, why are they doing it? Why are they doing it? Let's see. Is there anything like fundamentally wrong with if I use the EA of 85 and okay, so not following the rules for tax purposes, the only thing that changes is that for tax purposes, my corporation's cost is lower. This thing, this means I'm paying. Oh, it's pretty cool. I don't know. Hold on. Where's my brain going right now? Brian, get together. Is choosing an EA less than the cost like bad in some sense? Like, is it sort of like a penalty that the government is sort of imposing on you for choosing such a low EA or something like that? EA cost 120. I don't know. But okay, I don't know. So we're gonna leave this alone. We're just gonna assume that the reason this rule exists is because the government wants more money. And so they're like, wow, I can get more money if they do decide to leave it as recapture. It's pretty cool. Right, this is recapture, right? It's not terminal loss? Yep, okay. This will be recapture. Yeah, okay. So the government just wants more money. That's the gist of it, guys. That's the reason why the whole rule exists. Why this rule exists, I mean. Blah, 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 whatever. Okay. So again, we're going back to the thing. The EA number is three things. So it's for sale proceeds for the seller. So it's as if their proceeds is 85, blah, 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 in terms of their capital gain that they record. This is also the cost of the asset for the corporation. Unless this rule applies. If this rule applies, then the EA is no longer the cost. The original cost becomes the cost. And third thing is that this is the cost of the property received for the seller. I don't know what the difference between like this and this is. Sale proceeds, cost of property received. Actually, I think these two things are just sort of like they're sort of like backwards of like one another, like to basically show that when this person sold the stuff to the corporation, they got money back. Their proceeds from that sale is $85,000, and the cost of what? Cost of the property received is 85. Okay, this is to show like that I got like $85,000 in some stuff, and this is like all the property that I got from them is $85,000, which is kind of, it seems a bit dumb. Like it sort of seems like the same thing. Oh, okay, never mind. Okay, never mind. I think this is to sort of show like at the very end when we're sort of like figuring out the cost of each of the property that we get. This would come into play. It would tell us. Okay. How much do we have left? Ah, that's disgusting. Okay. So now we're going to do like a little example of how this stuff is used, okay? So in this case, we've got an asset. This is a depreciable asset because there's a UCC here. Fair market value of 100, cost of 90, and a UCC of 85. So what we first set up is we write down our fair market value, we write down our tax value. Remember, our tax value is the UCC, and if not, then it's the cost. We have a UCC, so we leave it as 85. And so remember, the elected amount, which is basically the amount that we're like sort of deeming to sell this thing at, is going to be our tax value. So we just bring this bad boy over here. That's it. Then what we have is basically this fair market value is the stuff that I give to the building, and the boot plus the PS is the stuff that I get back. PS is preferred shares, so from my sale to the company, I get I give them this machine that's worth 100K, and they give me back this boot and this PS. PS is preferred shares. Boot is any non-share consideration, anything that's literally any stuff that's not a share. So like a cash, debt, whatever. And one thing is that we love cash. Remember, this is the thing that I said at first. We love cash. So we want this thing to be as big as possible. And so we want it to be as big as possible because we want as much boot as possible. So like if I wanted to, I would be like, okay, let's just make the boot equal to 100K and I get all this cash instead of like all this getting preferred shares. But there's this rule that says that your boot can't be bigger than your EA. So it's sort of limited to EA. So even though I want to make this thing 100K, I have to make it 85, which kind of sucks. Next, we just figured out the preferred shares by basically doing the fair market value of the stuff that I gave minus part of the stuff that I'm getting, so the boot. So it's just 100K minus 85 equals 15. So that is our preferred shares. Basically, fair market value is a value of the stuff that I'm giving them. Boot and the PS is a value of the stuff that I'm getting. So basically, I want the same value of the stuff that I give out. Like I want like fair market value in has to equal fair market value out. Okay. Another thing is, so the EA, how we set the EA is so that the proceeds is 85 and the cost is 85. And so we get a gain of 0 for the human being. One thing is right now I'm using cost over here, right? Cost of property proceeds. Wait, no, hold up. If this was depreciable property, I would use over here my UCC. So the UCC, oh wait, no, okay, never mind. Right, okay, yeah. If I was over here, I would use the UCC. Right, see, this is what I was confused about. Oh my god, I should have asked this. Proceeds. Basically, over here, when it comes to capital gains, it's proceeds minus cost, right? It's not proceeds minus UCC. So my proceeds would be my new elected amount of 85, because that's the UCC. The cost is 90. So isn't that like a loss? Of -5 of loss? Oh my god, I forgot to ask this. No. Darn it. Okay. So this thing over here, sort of assuming that this is a non-depreciable thing. Okay, so for depreciable things that have like UCCs, the rule might be a little bit different, but right, proceeds minus cost, -5. Or is there a rule that your UCC can't be? No, seems fine. Okay, we'll worry about this later. Okay, blah blah blah, blah blah blah. Okay, so this is the first thing I have to look at apparently. So my first rule is that I want to report no gain. So my proceeds minus cost has to equal 0. So if my proceeds is equal to the cost and the EA is equal to the cost, that means that my EA has to equal to 85K, because that is the cost. Okay, so here's the thing. This example here is a bit kind of messed up because I was a bit confused. So for this part over here, we're going to assume that this UCC is the cost, and that I'm going to assume this is a cost. And we're going to assume that this is a non-depreciable thing, that there's only a proceed and a cost. Okay? Blah, 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 blah. So that gives us a gain of 0, which is kind of what I wanted. So it's like, yay, I'm happy, whatever. Next is that blah, blah, blah. Okay. I think I sort of talked all this stuff. Basically, it's like I get to pay 0 taxes because it's as if I sold it for the tax value. So my EA minus the tax value equals 0. I'm a bit confused why there is no capital gain over here. This example, I will ask about that. One thing is, remember that the boot can't be bigger than the EA, okay? That's just like a rule. Blah, blah, blah. Okay, I've already done this. Okay, so if the property is depreciable, then a UCC exists. So the EA would be equal to the UCC. So in this case, if I'm selling a building, let's say in this case the UCC was 85, less the cost, less the lower of cost and proceeds, which is 90 minus 85. This is 85, so it is 0. This is for recapture. This is for when I'm selling it to my person. What? Okay. This thing over here is, oh my god, I'm confused. This thing over here is when I am selling my building to the corporation. Building to corporation. Basically, I'm sort of writing down like what, UCC, what recapture I would have to pay. So I start off with UCC of 85, plus the lower of the cost and the proceeds. So the cost is the original cost I bought it at, which is 90. The proceeds, remember, the deemed proceeds is an EA, so that becomes 85. And remember that EA is basically the same thing as UCC. So these two things are used, so the balance is 0. And so I pay no recapture. On the other hand, let's say that I had made my proceeds equal to the cost. So let's say that for this depreciable property, instead of making that EA equal to UCC, let's say I did EA equals to cost. In that case, it would be like 90K, 90K. So there would be a recapture of about $5,000. Okay? And I wrote something over here, and I don't know exactly what I mean by it. Recapture proceeds. Wait, hold up. But there's still that rule that if the EA is less than the thingy, the blah 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 would apply. Like if the what's that thing called for depreciable property? That one rule. Where's that rule? Where did that rule go? I think we're going a bit too far up. Blah blah. If the EA is less than the cost, then the cost becomes a corporation capital cost. Well, that's for the corporation. Never mind. Okay. Okay, there's so many people involved in this. Okay. So this is from the sale from the person to the building. I mean, from the person to the corporation. I got this cost of 90K, proceeds of 85, blah blah blah. Hold on. What am I trying to say by this? Pay money now and save later versus save now, pay later. I'm trying to show that somehow this second option is better than the first. I'm not really sure where this is coming in. Like, what is this two different options I have? Okay. EA is less than the UCC. The EA is less than the cost. Wait, okay, that's a different rule. That's for the company, for the business. So in this case, what happens right here is if I'm setting the thing at the cost, if we had set the E at the cost, then I have to pay a recapture of $5,000 now. But what this also means is that since it is a cost and it's higher, in the future when I sell it, the proceeds minus the, basically like the ACB, aka the cost, would be lower because this cost is higher, right? Because I'm setting this cost to like 90K. Whereas in this case over here, I am setting the cost at a lower amount. Like I'm selling the proceeds as a lower amount, 85K. Okay, actually, I feel like I'm getting a bit confused. Okay, never mind. But in this case, with this, by setting the EA to the UCC, I'm using a lower cost right now. So I pay $0 right now, but in the future, I'll have to pay a bit more because there's that lower, it's a lower like ACB, lower cost of 85. Wow, this is so confusing. I don't even know what's going on. 90K. So what this basically means is with this first rule in the place where I set the EA equal to the UCC, I am saving money now and I'm paying later because I'm saving now, I'm paying no recapture. But if I were to set the EA to the cost, it would be this thing over here. So I pay now and save later. And saving money now is a bit better because time value of money, etc. So we're going to go with this guy over here. We're going to set the EA equal to the UCC. Okay, so the second step, this does not really work out too much. I was trying to figure out why the boot comes first. But the second step in this whole process is to allocate the EA. So remember, the EA is basically the amount, sort of like the value of consideration. Well, not value actually. Cost of consideration received by the seller. Received. Is it? Yes, received by seller. So what we have to do first is the consideration that I get. The consideration is basically just stuff, okay? The stuff that I get is either the boot, so the cash, or the PS, the preferred shares. So first I'm just going to write down the fair market values of each of those things, which is $85,000 and $15,000. This amount just comes from like whatever the whatever these numbers here are, 85 and 15. And that adds up to your total fair market value of 100K, of the whole fair market value of the building too. And now I have to allocate basically the EA, so this total EA of $85,000 to like the cost basis sort of the two things that I've bought. So I have to, the process to do this is to first write down the total EA, which is $85,000, and allocate it first to the boot up to its fair market value. So I'm going to first go, okay, 85K, let's allocate this amount to this bad boy first, limit of this thing. So we're going to set this allocation thing equal to 85K. And so right now there's nothing left because this is basically this number minus this number, 85K. This gives you 0. There's nothing left to allocate. So it's basically just saying like for who is this? Is this for me? Right, okay, so for human, for them, the ACB of those cash is 85, or like AR whatever is 85, and the ACB of their shares is 0. What this means, if they were to sell it in the future, let's say they're selling it for a proceeds of like 100K. Let's say they're selling those shares. The cost is now 0, so their total gain is like 100K, which is like a lot. 50K taxable capital gain. This is on like the sale of the shares. And if they were to sell the, sell the boot. Let's say the boot was something else like AR or whatever, and let's say that they're getting it for proceeds of 200K. Their ACV would be equal to 85, so their capital gain would be equal to whatever 115, I guess, or whatever, something like that. So that's what this stuff comes into place. So I'm a bit confused because where is it? Right. So over here, for a non-depreciable property, the proceeds are 85 of EA, but their cost stays the same at 85. I mean, you have to use their cost of 90. Wouldn't that mean a loss of -5? I'm a bit confused. Like an ACL of -5? Did I ask this question? I wonder. Uh, let's see. Blah blah blah, blah blah blah, blah blah blah, blah blah blah. Ah, yes. I did not ask this question. That's great. Okay, I will find out and I will update this.